The world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Dee Choubey is the founder and CEO of MoneyLion, a digital bank combining a comprehensive financial offering with AI-driven personalized guidance. With 4 million users and counting, MoneyLion aspires to build a private bank for the middle class, initially by providing financial access, education, and advice to Americans underserved by the financial system. I find MoneyLion's vision highly compelling. As we've said before on the podcast, it feels like many B2C fintechs are converging to the same business model. MoneyLion has sought to be there from day one. Dee and I connected at MoneyLion's beautiful downtown San Francisco office, which meant sirens, honking horns, and general urban background noise. We hope you'll bear with us, as the conversation itself was excellent. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Dee Choubey. Dee Choubey, welcome to Rebank.
Thank you for having me.
You're the founder and CEO of MoneyLion. Tell us about MoneyLion.
MoneyLion is a digital bank focused on the middle-income American household in the United States. We provide digital banking, investment management, borrowing, credit, as well as holistic financial advice to really Americans who are generally underserved by the banking system, but really those Americans that are aspirational about getting better at finances, saving for the future, as well as really enjoying some of the benefits that have really emerged here in Silicon Valley over the last 15 to 20 years by way of digital transformation in consumers that are really looking for that next generation mobile experience in banking.
So I was really looking forward to this conversation because I think your guys' model is awesome. I mean, if you kind of look around the world, and as listeners know, I'm based in London, so we're here in your San Francisco office today, and have been having a lot of conversations with U.S.-based fintechs over the course of this week. And everyone's kind of approaching things from a slightly different standpoint. They're different products that kind of work better as entry points in different markets.
Sure.
So in the UK, it's kind of been free current accounts on an app, free FX, huge in Europe. In the US, more free investments or free stock trading, robo-advisory has been big, and then lending. Right? It's kind of a country that's traditionally supported a lot of consumer expenditure through credit, and everyone, I think, aspirationally aims for the same endpoint, which is kind of a comprehensive offering across banking and investments and lending, with kind of a some sort of like behavioral or guidance, kind of smart advisor overlay on top of that, and everyone started a different place to get there. And I think you very optimistically, confidently started out of the box to build the end-to-end proposition.
Yeah, look, I mean, I think taking a step back in terms of this wave of financial technology innovation, if you look at what happened in the late 2000s, the banks were left on the sidelines, really, here in the U.S., in terms of just really providing products that surrounded the consumer with choice. Because really what was happening was the liquidity crisis, the credit crisis, if you will, or the credit crisis really was a liquidity crisis for banks. The regulators globally really focused on safety and soundness of the financial system. And really the loser there was the American consumer. Because if you think about 60% of Americans have a credit score in the traditional sense below call it 640. And from a regulatory box perspective, that became generally toxic for a bank's balance sheet. So while 70% of Americans had deposits with the top 100 banks, they weren't able to borrow from them. And, we really looked at that insight where there was an adversarial relationship with the traditional bank because you put your deposits with them here in the U.S., but really you weren't getting anything in return. And in fact, if you had low deposits below $500, you were really unprofitable for the bank. So they would do everything they can to charge you fees. I was talking to one of our customers who switched from Bank of America and then another one that switched from Capital One. They were both saying that, look, every time my balance is below $100, I get charged $12.99. So we started really patching together a lot of these insights in terms of how the American consumer was interacting daily with their financial institution. And what we really learned was there was a lot of financial stress. There was financial stress around, paying that $12.99. There was financial stress was, okay, look, in those 3 months when I run out of money, who is going to help me out? Credit limits were coming down, again, because of this idea that the regulators were focused on safety and soundness. And that really created this idea, this vacuum here in the U.S. where the unbundling of the bank happened. So early in the 2010s, let's put a loan quickly online. Let's put an insurance quote quickly online. Let's put a credit score for free. And you saw the emergence of those business models. That's really when we started MoneyLion, was when that first unbundling of the bank was happening. And what we realized, though, because we did start with a fairly hefty team of machine learning folks and AI folks. Our CTO has been writing papers on AI since the 1990s. He was predicting how tank movements would impact war strategy in the Middle East. So when we brought him in, we were bringing a bazooka to a knife fight. And what we realized was we needed lots of data. So the early innings of MoneyLion was just solely focused on getting an intimate understanding of financial stress as it existed in the American consumer's balance sheet, P&L. And as we started seeing that data come through, we realized that to better help this consumer in those 3 months when they have massive deficit, we need to become a lender. So that was MoneyLion 1.0. Was we were providing very fast, easy, non-FICO score driven decisioning where consumers can get loans in 5 minutes using a mobile app. And this in 2014 and 2015 was pretty novel.
And that was pulling in social media information, right? Wasn't there like a Facebook connection sort of setup?
Look, initially it was maybe the first pilot of it was, and as we raised our first seed round, the lawyers quickly told us not to do that because in the U.S. the regulators like that any credit decisioning is made on empirically derived, statistically significant sources, and the credit bureaus have a monopoly on that. So ultimately, when you're denying someone or you're accepting someone for credit, it has to be kind of driven by that. But really, the connectivity to social media data, behavior data continues to be part of our platform in terms of how we generally create a very personalized and contextualized experience. We took those learnings, we took the early learnings from, your initial question was really why do all of it together. It's because, being a lender, being a data-driven company that was looking at habit change, we realized that the American consumer, that the same consumer that was taking a loan in December, also had $500 to $1,000 of surplus in May. So how do you build a brand that works for that consumer in May as well as in December? And then we realized was that if that person had put that $500 into an investment account, number one, that investment account would have compounded, and number two, that consumer would be able to use that as collateral. The reason why people pay high interest rates in the U.S. is they have little collateral. That's because they spend more than they should in months where they have that surplus. So we really focused on building a product that would combine those two behaviors in one platform. So when we launched our robo-advisor, it was actually meant for that same consumer that we were lending to, that in May would actually put that $500 into the investment management account. And then again, when December came, because unfortunately patterns repeat, human beings are generally, we follow our own patterns and we follow our own devices. But really, when that happens again, I'm able to actually borrow from myself at an incredibly low interest rate. The platform has trust in that consumer because I've seen habit change that this person's actually taking a positive step of putting the $500 into an investment account. So if you fast forward to 2019, today 90% of the credit that's originated on our platform are one way or another secured by assets that exist in the consumer's investment account. So this idea that we've built, we call it, in a lot of ways, the private bank for the American middle class. If you think about the high net worth population, you have assets, you have real estate, you have art, and you can circle them with Chase Private Bank and say, okay, give me some liquidity against that, and Chase will do that. Or in Europe, others would do that, Coots and whatnot. In the U.S., for the middle income American household, that just doesn't exist. Here we've taken the best of fintech transformation from a technology perspective, combined it together, and really provided this behavior change where I buy into my investment account in those 9 months where I have small surpluses, whether it's $5, $15, $50, and I build up $500 to $1,000 for those 3 months where I have a deficit. So instead of going and paying triple-digit APRs or double-digit APRs to installment lenders or credit card lenders, I think that even if you think about a Capital One credit card, it's still in a lot of ways 40, 50, 60% APR product because you're paying fees, monthly fees, revolving fees. So we end up becoming a credit card replacement for that consumer, and we end up becoming a fan of that consumer where we're interacting with them in months where they're doing good, and their first call, their one click away insurance product for those 3 months where they have a deficit.
Why do they have a deficit in those 3 months?
Look, I think if you look at general American spending, and we've seen now.
And which 3 months? Over the holidays or something?
It's generally November, December, January.
Okay.
But there are other times where there's some regional differences as well. Sometimes over the summer for back to school. In parts of America where you're driving a lot over the summer, there's some automotive issues that cause deficits. But we're in a generally benign unemployment regime recently, but nevertheless, financial shocks and emergency shocks are still happening with this American household.
Yeah. So, one of the things that I've heard referenced a number of times since I've been in town is the something like 160 million Americans who don't have $500 in savings, and you could probably slightly tweak those various numbers, but I think that the point is that most people don't have access to the kind of immediate liquidity that they would need for that kind of crunch event. Is that your experience and your customers' experience?
Yeah, look, I think it's just a behavior difference here in the United States that credit is part of how we live. You're 15 years old and you start building your credit. I remember my dad got me a credit card in high school just to start, showing up on the bureau registers. So it's something that consumers here in America have gotten very comfortable with. That said, not having access to credit is a big source of financial stress, and we play a small part for our members to demystify that, where we say that, look, your credit score outside MoneyLion is one thing, but your habits and your behavior inside MoneyLion is another thing. So what does that really mean? All we ask for consumers is to buy into their future, which is invest into invest in yourself by investing monthly into the MoneyLion accounts. Yep. And then as we see that behavior increase, we're able to release significant liquidity for that consumer, because we know that financial stress will happen. We know that cars will break down. We know that emergencies will pop up. And we broadly as a society don't do a great job of saving money. So just unearthing different ideas of saving more, whether it's through a steady income product that we just released where it's 98% bonds. And think about that, right? The $50,000 household isn't really thinking about a 98% bond portfolio, right? But we're demystifying that. We're calling it steady income. We're calling it invest in yourself for steady income, right? Or it's a high yield savings account. So high yield savings account, again, aren't things that the average American household is thinking about. But just unearthing that through very simple colloquial advice, we're seeing lots of different behavior change with that as well.
Yeah, and I think that's why the the model is so powerful? Because on one side, you kind of have companies that are trying to build customer bases through a single product and then expand into multiple products and then solve the problem of, I guess, coordination and guidance and behavioral stuff later on. And on the other hand, you have companies that are seeking to be behavioral or advice or guidance layers that kind of sit on top of your other accounts. That model is proven to be very difficult because you don't actually own the underlying accounts and the connectivity, and you can't own the entire customer experience. And to really solve the problem, you guys have basically addressed it all at once. And I think most entrepreneurs would probably think, wow, that's kind of biting off more than one can chew, and it probably costs way too much to build. And I don't know, then you end up spending all this time building this complicated offering, and then by the time you get to market, maybe it works, maybe it doesn't. But I don't think that's the way you guys initially approach things. In fact, I think you were quite economical at the beginning in getting to a proposition and getting it to market.
Yeah, look, I think everything that you said are feedback that we've gotten over the years. We've probably been sent out of many venture capital firms' offices saying, hey, Dee, your MoneyLion, you guys are, they're very well-established, well-funded businesses for each one of these verticals. But the tack that we have taken is that our product is demystifying financial stress. We're dedicated to ending financial stress for all Americans. So that singular mission has allowed us really to just be data-driven entrepreneurs, data-driven operators that just look at these inflection points for our consumers. And that's really guided us in terms of how we think about product build. And really, I think that our business has been able to be, we've built this incredibly efficiently from a capital perspective because of what's happened on the technology side of the world. Banks have become really the plumbing. Someone was telling me yesterday, look, my kids come in and they get radiant heat all the time. They have no idea that there's this massive furnace in the basement. They think that the entire house is powered by Nest, right? But Nest has done a great job of becoming the interface layer of all of the plumbing in the house. Similarly, banks have become, lots of banks have become the plumbing of businesses like ours. So our ability to tap into the payments ecosystem, the banking ecosystem, all of that has become relatively easy, where you can then go build significant value for your consumers at a very low cost of service. And that probably wasn't possible 5 years ago or even 3 years ago. So as that technology has improved, as the banks have gotten more comfortable with partnering with companies like ours, we have been very strategic and very opportunistic in terms of because we see how our consumers spend, right? There's $150 billion of spend that gets tracked on MoneyLion on an annual basis. Wow. So we know how much money is going to Mexico with remittances. We know how much gas is going into cars. We know how many tacos are being eaten. We know behavior. We know paycheck decay. So one of the core technologies that we've built is this idea of predicting when you will get your paycheck and how quickly you'll spend it. And that's really been the single thing that we've focused on. And around that, we've built this idea that, okay, when that paycheck decay is longer, let's invest more. When that paycheck decay is smaller, let's give an insight to the consumer that, hey, we have some credit products for you to go help you with that.
Can you talk a little bit about the way that you've designed and structured the model? Because it's much more than some sort of just the interface, right? As you described, Nest to the furnace. I think you guys go relatively deep in terms of the infrastructure.
Yeah, so we're a registered investment advisor. We have the ability to lend money in 50 states through a partner bank. We have our own digital banking capability that, on the back end there's a bank, but really the technology is ours. The ability to move money in and out are ours. The way we've, again, kind of structured all of this is, we were talking about this with someone else, is that, self-driving finance, there's lots of, academic work around it. The technology is there to do it today. Right. So what we're trying to do is build self-driving finance in a thoughtful way where the consumer actually, engages with it. So this idea that with one membership, you're getting a brokerage account, you're getting the ability to borrow money, you're getting a financial advisor, you're getting a bank account that doesn't charge you any fees, and you pay one monthly fee for that.
Yeah.
That's resonating very strongly because what we have shown is that with $500 accounts, with $50 accounts, we can still cost effectively, economically service those accounts because the consumer is buying in that for the fee, for less than one NSF fee a month, I'm getting access to everything.
Yeah.
All right. So this idea that, Hulu and Spotify and Netflix paved the way, that you're consuming everything as a membership, music, content. Why not consume the entirety of American financial services with one membership fee? And that's really what we're proving out right now.
Can you just explain the pricing model for those who aren't familiar with it?
Sure. So we have a couple of different ways that we interact. I mean, firstly, most members don't pay us anything to use MoneyLion. It's free to use. Then there's a freemium model where you get our bank account. Again, the consumer doesn't pay us anything there, but we get compensated through interchange and other ways in the back end with the banking system. And finally, the third way is a membership tier, where we charge anywhere from $9.99 to $29.99, depending on how much you consume and what you consume, really to get the entirety of the private bank, if you will. So with that, you get high yield savings, you get your investment management account, financial planning, wealth planning, all of that is included in there. That's an industrial strength. We partner with a company called Wilshire to select our ETFs. So this is fairly sophisticated ETF selection based on goals, based on sleeves that are being made available to consumers that really weren't thinking about this. 87% of our members are first-time brokerage account openers with us, so that's an incredibly amazing stat. And then you get the high rewards checking account with that as well. And really, we're trying to become a part of someone's lifestyle. We're working very hard with our partners. For instance, we have a partnership with an automotive company, Ford. If you're a MoneyLion Plus member, you get $1,000 off your first Ford. So we're not only trying to be a bank, we're trying to belong to a membership, and we're trying to become something that consumers really spend 60 seconds a day with. And that's really the strategy there.
And isn't there a piece too around if they are engaging, that you're actually making investments into their account for them?
Yeah, so there are a couple of different flavors of the membership. One is a low touch one where you pay, it's a lower fee. There's a segment where we would charge $29 flat a month, and then you can earn it all back into your investment account if you log into the app every day. And the app is all around financial literacy, financial wellness, all the things about unearthing insights. We want our consumers to interact with that. And we see that on that feature, we see about engagement 80% of the days out of a month, right? So consumers pay very little for the product if they engage positively, and there's really massive loyalty with that segment in terms of there are best users on utilization across the board for the product.
Yeah, I think we're starting to get into some of the behavioral stuff, which is I think really the differentiator and the most powerful piece about what you're doing, and kind of owning all of the components allows you to then in a very kind of intelligent, sophisticated way deal with that. There's one feature I think that maybe you launched recently, the financial heartbeat.
Yeah, financial heartbeat.
I'm
looking at it right now. I have my score just went down. I was looking into why.
Probably hanging out with me. Tell us about that. I mean, that's potentially what a lot of consumer finance should be aspiring to, right? It's like the anti-confusing approach to displaying helpful information.
Yeah, look, I mean, because we iterate so much on our product, and we're so obsessed with engagement and time spent on our platform, we realize that consumers hate getting bad news, right? So a way to kill engagement is tell someone that they're going to run out of money, or tell someone that they didn't pay one of their loans on time, or they're late on something. Because we as humans, we know that there's a problem. We generally know that there's a problem, and there's a good reason why you didn't make that payment. So we wanted to create a very iconic and visual way to represent it's okay. A Fitbit if you will, for your wallet. The financial heartbeat is really a behavior index. It's not just your credit score. You can have a very high financial heart score while having a 500 credit score. It's actually just measuring aspiration. It's measuring your habit. It's measuring your literacy. It's what you're doing. And it's okay to start off with zero literacy. And you'll see that when you download the financial heartbeat that, it's telling me that I have a 7 out of 10. Your hard work is paying off, but you have a lot of work to do. And I look at it, I'm doing okay on investments, but I have a lot of work to do on my spending health. And I can drill into that. And I can drill into that, and it'll tell me that I'm actually spending a lot more than I'm making, and that's really what's driving, that score to be a 2 out of 10, and that's dragging everything down. So we'll go through that in a second, and then it's telling me that my credit score actually went down month over month. So it's all integrated into data sources that we all trust. The credit scores are provided by TransUnion, and if you're a member, again, this is one of the perks of being on the paid membership. We actually refresh that at our cost, the credit score on a weekly basis. So you have an incredible pulse on not only your credit score, but what you can do to make that better. Now, remember, no one is looking at their credit score to see a 3-digit number. Right, you're looking at that credit score, and it's telling you what type of house you can live in. What mortgage can you afford? What type of car can you drive, and how much you can buy on credit. Right, so that's why that number becomes a pretty significant measurement. And we're seeing lots of engagement with people that are just gamifying it with themselves. Like they want that 15-point increase, and in that regard, the platform then becomes a game. Because you're actually playing a video game with your credit score, and unbeknowingly, a lot of times, you're making your life a lot better just by buying one less coffee a day or by taking one less Uber ride a week. You can really, really those things can add up. These coffee table conversations, for instance, right? So, what we have learned is, when you sit down with a middle income family and you say, look, you have 3 cell phone bills, one for the mom, one for the dad, and one for the child. And that's coming out to $300 a month. And over the course of the year, that's $3,600, right? $3,600 now starts resonating. So maybe we don't need a cell phone for everybody, or there's a cheaper family plan we could do, or we could do a prepaid plan. So those types of insights live inside the financial heartbeat. In addition, other examples of it are if you're in your 20s. No one teaches us about personal finances in college. We could go to an Ivy League school and still come out, without much information about how to buy insurance. Lots of debt. And then again, those conversations now live inside the financial heartbeat. Is okay, if you're 25, this is the time to buy insurance. It's the cheapest it'll ever be. Buy a lot of it, right? Lock it in for 50 years, and and we make that very easy to act on as well inside the financial heartbeat. And the more you do that, the more your heart increases, right? So it ends up being this living, breathing Uber score that sits inside the mobile application that everyone interacts with on a daily basis.
Yeah. I wanted to pick up on the kind of iterative approach to the way you develop the proposition. And I think I heard you say in the past that the sense of what I heard you express was something around almost the transience or the impermanence of the products or the features or the capabilities that you're developing, i.e., it didn't seem like the mindset was, this is the proposition that we need to build, and once we built it, it's done. And it was almost more, this is what we're launching now. It's constant product feedback with customers, seeing what works, seeing what people like, iterating, changing, ripping out, rebuilding, and just kind of constantly evolving as a business. And if I've kind of captured that correctly, that's a really powerful way to think about in modern times, building a consumer tech business that stays current and competitive.
Yeah, no, I think it's a good point. I think the way we think about our mission here is that we want financial services for our consumers to become part of their life, part of their lifestyle. So everything we do with the product is to ultimately get it there, where doesn't feel like a bank. It doesn't feel like a rote, borrowing capability, but it's actually sitting inside how someone thinks about their day, from a planning perspective, from a payments perspective. And then what we're seeing is that once you build that trust, you'll be able to do that in an economically viable manner. More people will bring their salaries to you, so you're seeing a lot of spend. You get compensated on that spend. In those 3 months that we talked about, when there's a need for credit, you're able to be that credit provider, and there's some margin there. So as we think about continuing to be more and more part of that lifestyle, it has to be measured against making sure that it's economically viable, because you pointed out earlier that capital and resources they're finite, and you have to make sure that you're allocating them correctly. So that's a process we go through on a daily, if not hourly basis here at MoneyLion, making sure that there's alignment, both from the stakeholders' perspective, but more importantly, if consumers are engaging with us, we know that in this environment, there's lots of appetite from stakeholders to continue building a large user base.
One hears a number of times, or rather, quite regularly. It turns out, spending time in the U.S. fintech community about, and we kind of touched on it before, that kind of half of Americans that have potentially financial issues, and the whole concept of financial inclusion and serving clients who maybe aren't best served by banks. And at least in the UK, that's proven to be a difficult segment to serve because they're just not profitable. It's very difficult to kind of run an economically viable business model and meet the needs of those customers. You hear a lot of people talking about the average American and helping solve their problems. To what extent is that kind of a euphemism for subprime borrowers and lending money at higher interest rates to kind of achieve profitability? Yeah,
I think if you look at the industry 10 years ago, without the advancements in technology that we have seen, and if you're thinking about just traditional ways to interact with consumers where you just lend them money, you're absolutely right. The book and the market show that it's very hard to build large, scalable, profitable businesses just catering to consumers the quote unquote subprime, near prime universe. And there's a reason why the banks have ceded that to the non-bank, especially finance companies. But what we have seen is that with the evolution of technology, the cost to service those consumers have come down drastically. The ways to engage them innovatively, where it's more payments-based or fees-based, allows you to have conversations that are incredibly economically viable with that same segment. And look, I think the business models that will succeed are somehow changing those engagements, interactions into sort of a advertising model, or changing it to pay what you want model. There's lots of businesses out there that are saying, look, we're going to give you financial services, pay us what you feel is fair. Those businesses are doing really well, and that's a component inside MoneyLion as well in terms of salary advance. We'll advance you up to $250 of your next salary at a 0% interest rate. And you'll see that a lot of our consumers are incredibly ingratiated by that, and they want to help the community, and they'll give you, a dollar tip here and there, right? So those all add up and become pretty economically viable ways to interact with a consumer. But that capability didn't exist 10 years ago. The only way that you can interact with these consumers is to write them a loan, and that loan had to be at a high interest rate because you had 20% default rates that you needed to cover.
So you talk about memberships and your members, which clearly suggests that you have a different view of your customers, and it'd be interesting to hear you talk a bit more about that in the context of your kind of vision for the future of MoneyLion and kind of the extent to which the platform can really touch other areas of people's lives that aren't traditionally banking and finance.
Yeah, look, I think we focus a lot on the community here. One of the lines is that you don't need another bank. There's 4,000 plus banks here in the U.S., and a lot of them do a good job of their core competencies. So when we think about the bank of the future or the financial platform of the future, it's all grounded in lifestyle. It's all grounded in, can we help you change the way you work, the way you think about the future of your family, and can we have a small part in really kind of recommending or being part of those inflection points? And that's why it's an engagement-based model. And when it's engagement-based, the consumer feels that they're getting lots of value for paying that $9 or $19 or that $30 in membership fees that they pay us. And back to your earlier question, that membership fee construct allows you to be, we see very low churn on that. And one of the ways to service the segment that's kind of been seeded by the banks is to create 3, 4, 5-year relationships where they're continuously a member. And for that membership, they're getting significant value in return, so they feel very good paying that membership on a monthly basis.
Yeah. Look, I genuinely wish you guys all the best. I think this is an amazing model. Dee Choubey, thank you very much for joining us today.
Thank you very much for having me.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.